Okay, we're recording. Hello, everyone. This is Jim Riggio and Tom Nunemaker, and this is the roundtable for September 27th, 2017. I'm going to be presenting basically what's going on in the market with high-frequency traders and others, that 2017 has kind of been proclaimed the year that volatility died. Quick disclaimer, though, before we get started. Capital Discussion is not a broker-dealer investment advisor. This presentation for educational purposes only. We have no way of knowing your situation or what level of risk is appropriate for you. We're not making any trade recommendations. Any trades that we talk about are believed to be accurate, but there will be variances in your P&L, such as due to such factors as liquidity, slippage, and commissions. I have talked to at least a dozen different institutional traders and money managers. And every one of them sounds like Janet Yellen. Okay, why is inflation so low? Why did volatility die? We don't know. Okay, a lot of things are broken according to the way their book used to work. There are different theories. The theory that I think probably makes the most sense, and I heard repeatedly, was that there are people who figure things out first and make a ton of money on them. And when they figure them out first, usually now it's very math-based. So one theory was floated was that, some huge hedge fund, okay, that has a huge amounts of leverage has been able to end up understanding the different algorithms and different strategies that high-frequency guys use and the other institutional, active trading uses, and they've been able to curtail it, because normally what would end up happening is that high frequency and algo guys, they want to see movement. They really want to see movement in one direction or another. That's where they make their money. Having no movement means that they're just, they're getting, chewed up. Every time they think that something's going to end up moving, it doesn't, it comes back. And so there's been a ton of reversion to the mean and time consolidations going on, right? Those are terms that we use all the time here. I'm just going to end up assuming everybody knows. Basically what I'm saying is that the market tries to break out, it fails, it comes back into a range. This has been happening on daily timeframes and intraday timeframes for the year tremendously. The thing that when we look at volatility, I want to make sure everybody realizes we're talking about two different types of volatility. One is a look forward and one is what actually happened. We're going to be talking about what actually happened. Okay, implied volatility is a look into the future, and it's basically what's the market pricing in the options market, what's implying that the volatility is going to be over the next 30 days or whatever time frame you're looking. When we take a look at realized volatility, it's what's happened in the market in terms of its range. Now, a market maker once ended up asking me, he says, you need to understand what type of volatility you're talking about. If I said, a stock opened at 100, okay, closed yesterday at 100, opened at 100, and closed at 101 cents, is that a volatile stock? And say, no, that's about as boring as you can possibly have. I told you it opened at 100 and it closed at $100.01. What happens if during the day it went down to $80, then in the afternoon went up to 120, and then sold off hard into the close and closed at $100.01? He says, oh, wait a second, that's a very different story. What happens often, okay, before markets start to end up moving in a big sell-off, you tend to end up seeing more intraday activity and more intraday swings. The graph that I'm showing you right now, I'm not logged on separately. Tom, you can see the graph, right?
I can, yep.
Okay. What you're looking at is a daily chart as far as I could end up getting, or as much as I could end up getting in a single Thinkorswim screen. As you see, I can end up going back, okay, 20 years, right? That's 1999. Okay, 1998. And you can end up seeing where the S&P was. And I have moving averages on here, but I want to focus on the two bottom graphs. Okay. This first graph, instead of using any default, formulas or, complicated technical analysis. One of the things that I had done with the EAB guys, they're the ex-Goldman guys that basically sell hedging services for a living. Obviously, they're going hungry this year because nobody really wants to end up paying for hedging because the market hasn't gone anyplace. What you're looking at is, let me move this back up here. On the top line, there's a number around 21 where we've been for basically since the US elections. You can see that 21 has been the number here for the ATRs. For those of you who are not familiar with ATRs, a quick 30 seconds. All an ATR is, it's an average true range. And the reason why they call it a true range and not an average range, it's just the high minus the low for the day. And the true portion, it means it includes any gaps from yesterday. So if there was a gap, it'll take a look at and include that gap in the high and the low when it measures it. The smaller the daily range, the less activity there is. So one of the things that many traders and institutions will look at is these daily swings. And when I take a look at, well, historically, we've been between 7 and 21. Now, remember what 7 and 21 mean. It is an absolute number. It's 7 and 21 points. Now, I'd say is 7 and 21 points, is it a big number? Well, no, it's tiny when you consider the index is up here at 2,500, right? This is tiny. Now, would this be a big range if the stock was at 100? It would be huge, right? So it's an absolute number. It's not a percentage, okay? That's the first thing that you need to end up realizing. So if you're going to compare ATRs, like we have to here with Thinkorswim, you have to look at an absolute number and not as a percentage. If we looked back 10 or 20 years on the S&P and it was a half or 1/5 of its current price, you'd expect the ATRs to be much lower because it's a much smaller number. Okay, that's number one on this graph. We've also done the same work and we've looked at it in terms of percentages. Okay, it's not in any pretty form that I can end up showing you. It's a tool that we end up using and it puts out different reports that are proprietary. But I want to end up sticking with these numbers right here. Look at where we've just been. We broke 8. We were down at 7.75. You have to go back to 2011, on Christmas week, okay, for it to be lower. I mean, nobody trades on Christmas week. If I go further back, you can see that we barely ever touched, 7, okay? If you go back and take a look at it as a percentage, you can't find anything because while you're slightly below it here, if you take a look at where the index was about almost 2/3, a little bit less than 2/3 smaller. Okay, smaller. So that means that this number here, if it was the same, would be 2/3 smaller than 7, and it should be at 3.5 or so, or 3. So from a percentage point of view, okay, we are at a historic low, okay, in terms of how small our ATRs are if you look at them as a percentage and not an absolute number in the history of the S&P. Okay. Why is volatility, so small? A lot of people ended up saying to me, well, it's government, okay? One guy said, it was funny, he used the word Trump. And I laughed and I said, would Trump, I've never heard the words less volatile and Trump in the same sentence before. But what's going on is that there's nothing in the government that is going to end up playing a big role in what's moving forward. Yeah, there are taxes, but the fact that the government is stalled, the markets absolutely love, because the thing is that they usually think that all lawmakers can really do is put new laws in and mess up the economy from the way it is. They'd rather see nothing happen. The biggest news item is that, I forgot what Trump called, Rocket Man, that's what he called him. Okay, the Korean, I think he also called him the Korean fat boy once. It's got nuclear toys that he's trying to play with, but there's really not a lot going on in the market that we can hang our hat on and say, oh, I'm worried about the economy here, I'm worried about the economy there. It's kind of moving rather smoothly. There were other things too. Okay. Other things that are going on is that when the markets, after 2008, let me put it this way, after 2008, Graham-Dodd, bill was passed, and there weren't a lot of details in it. They were going to be put in over the next several years. And one of the things that happened as a result of that is that large institutions weren't allowed to use the same level of leverage. Okay. You remember back in 2008, 2009, they would talk about, oh, they're privatizing profits and socializing losses. So therefore, the banks can end up taking the amount of risks that they used to take. Well, if the banks can't take the risk, that means they can't provide the same margin requirements to their clients. And you guys know that, right? You've seen anybody who has portfolio margin from the beginning, right? If you guys have portfolio margin, and I don't know if you have, does anybody want to end up chatting in, okay, what's happened to your portfolio margin account, okay, since the beginning when you first got it? I'm talking what, maybe 10 years ago, 12 years ago? A lot of brokerages have tightened it up. Like, let me give you the rule that when it was first passed, right? The rule when it was first passed was that if you're going to end up investing in a broad-based index, and broad-based index is when this thing, the S&P 100 was actually traded as much, if not more, when it was passed than the S&P 500. If you're going to end up investing in a broad-based index, such as the S&P 500, the S&P 1 index, and you have portfolio margin, your portfolio margin is you only have to have enough cash in your account so that you could withstand a 6% gain in the S&P 500 or an 8% loss. That was your whole, whole margin requirement. Okay, if your loss was less than 8%, no matter what happened of the price of the index, you could end up investing it. Well, what's happened is that the banks could not end up handling that level of risk and also all of their margin requirements. And slowly, our margin requirements for portfolio margins have gotten more stringent. We've had to put up more capital. Now, one way the high frequency guys and the algos and the rest of them have done is that they've bought out of the money cheap puts. This kind of went into effect in 2011. And let me show you a little used index, because it's kind of, in most institutional people's minds and in mine, it's kind of useless because there's so much noise in it and it's so inaccurate that it really can't end up transmitting any useful information. What do you do when you end up having an index that just has way too much noise in it? Well, the way you end up handling that is you put a moving average on it. So several years back in early 2011, the SIBO came out with an index that they publish at the end of every day, one number at the end of every day. And basically it is how expensive it is to buy teenies. If you guys don't use the term teenies, it's something market makers used to use. It means puts way out of the money, maybe 10% out of the money. Now, they're usually very cheap. Okay, and how expensive they are compared to the puts at the money. Of course, they're going to be a lot more expensive. Let's say if the VIX is at 30 than if it's at 9. Okay, when it's 9, they're going to be cheap. So really, what we're looking for is how expensive those teenies are relative to the puts at the money. Right, that makes sense. That difference, right? That difference is called skew. Okay, because one is skewed more than the other. The problem with it is that if somebody decides that, oh, I really need to get this insurance, and you know what, I know the puts are, let's say, $1.50. I'm going to pay $1.75. It's only an extra quarter, but I really need to. The problem is that extra quarter makes a huge difference in the skew reading. And that might happen today, but tomorrow there might not be anybody who does this. So you get these movements all over the place, so that it really is a useless thing to end up telling you anything that you could trade off of. However, if you look over the long term and you put, let's say, a 200-day moving average on it, like I have here in the red line, you can see clearly that over time, since these laws have gone into place, that the cost of puts has become more and more expensive. Now, one of the things one might say is that, well, skew usually becomes steep when IV goes low and the market's moving up. Yes, this is true. This is definitely true. But when you take a look, what's happened is that we had a bullish run here, and we had a very bearish run here. Matter of fact, the bearishness, okay, in this part when we thought that we were going to end up, the U.S. was going to go into, I'm sorry, over here, where we ended up having this big sell-off, okay, you know, more than 10% in just a couple of days, and the VIX spiked beyond a belief. We didn't even get down to where we were on levels of skew back over here. And remember where this was, okay? This was that the government was having problems. We might not pass debt and stuff. And so what's happened is that we make gains, or the level of skew becomes steeper. What that means is that we're paying more and more for our puts way out of the money. And then when things get better, we don't give back all of the skew. And then things get better, and then we don't give back all of the skew. Now, this has been a recurring theme over and over and over again. And so while we're at, we go through cycles, and you can see the cycles because the green line is the 20-day moving average and the yellow line is the 50-day moving average. While you go through cycles of skew being more expensive and less expensive, and you can see pretty clearly the cycles in the 20-day moving average, some of the noise has come out, and you can see definitely the cycles in the 50-day moving average, but it's clear in the 200-day moving average, while you can still see those cycles, we make gains, and it's becoming steeper and steeper and steeper. Now, why are people buying these puts so far out of the money if they don't if they don't need them, right? Well, right, we're not moving down. Why would you pay more relatively for a put if the market never seems to go down? One of the ways you can end up doing this, if you're a long portfolio, which a lot of the big institutions are, you can end up buying these out of the money puts to reduce your margin requirements. You can reduce your margin requirements, and now you can end up, okay, buying more stock, okay, for the amount of money you have. Now, when you're in this type of environment, two things happen. One, you have protection underneath. So now if there's a sell-off, you don't really worry too much about it because you have a put in place. This becomes a buying opportunity. So now when there's sell-offs, there are going to be more institutions that are going to end up buying because they have this extra protection in place. So it's kind of been a byproduct of, you know, the government trying to help, right? The government tried to help and say, oh, let's not use so much leverage if we don't have so much leverage. I forgot the number. What is it, 11 words or something? In the scariest words in the English language, I'm from the government and I'm here to help. By doing this, they've taken volatility out of the market. Now, some people might say that's good. That's, you know, it's more challenging for us as volatility traders. But this graph clearly shows that on an implied volatility, remember, because this is they're willing to buy insurance, and so that's what they're implying the volatility is. In an implied volatility, the puts below the money have become much more expensive than the puts at the money. What's happened here in the VIX? Okay, you can see here in the VIX that yes, we've had some scares. Now, this is, I pointed this out the other day. This, I don't know if Paul, I always kind of tease Paul because it's every trader went through this, but Paul still ends up having, you know, like seizures every time we go through this, I think. This was those faithful days starting on the 20th and 21st of August in 2015. It wasn't, you know, if you were in business, there was like some stuff going in on China. Okay, they were going to end up doing something and not do. It was kind of like a minor thing. But the markets took it, oh my God, if China collapses, okay, the world is going to end. And we went through 4 days of hell. And you can see what ended up happening here. The VIX got up above 50. And let's just put a VIX above 50 in perspective, okay? Let me come back here because I have 20 years, okay? I thought I had 20 years. No, okay, there we go. Okay, let's go through the dot-com, okay, run up, the huge sell-off that we had in 1998, the big sell-off we ended up having, okay, in the summer of 1999, and then just the absolute crash going into 2000. The VIX never got to 50, never got to 50. And think about the level of impact that that had on the economy. That was huge, absolutely huge. Where did we get to, okay, on these days that were like a non-event, and when they realized it was a non-event, we came back down, we got up to 53. So we actually got higher. And if I do this, you can see this if I put it all on a monthly graph. Let me do this just for a minute. Okay, you can see here, other than the financial crisis of 2008, that's the highest that we've gotten. Now that is obviously after 2011. And if you remember, here, let me just pull this one back up again. Okay, I want to just put this graph, I can't overlay them, but I will end up seeing here. So this was in 2011. So we're talking about, you know, the huge spike that we ended up having in volatility, and skew got to be a little bit flatter. That's what you'd expect, by the way. Okay, skew to get flatter, okay, when the markets start to go crazy, because people are willing to pay a lot more for the puts at the money. They're still willing to pay for those, teenies way out of the money, but they're willing to pay a lot more for the puts at the money. Hence, that ratio makes the out of the money puts relatively cheaper, not because they're cheaper, but because the at the money puts are so much more expensive. And you can see even in the 20-day moving average, yes, that was the low point, okay, that we ended up having, but it wasn't anything huge. So what does all of this mean? It means that the market has been, for the last 6-7 years, been acting more and more calm until the excitement comes. When the excitement does come, where there might be some type of issue where the market could sell off, significantly, the volatility spike incredibly quickly. It's kind of like the game has almost been put on pause until there's some type of danger, and then when there's real danger, it just spikes incredibly. Okay. This is a challenge, right? And this is why nobody knows what's going on. Usually what ends up happening, and let me come back to the other graph here first. The best way for me to do that, so I guess, would be this. I don't have it there. I have it over here. I moved it. Okay. By watching, okay, realized volatility in ATRs. Okay, if the realized volatility in ATRs will end up telling us that the market's moving around more. High frequency guys need the markets to move in order for them to make money. They don't care which direction, they want it to move. Down is usually good because it moves faster down, but down is also a little bit scary because if it goes down too quickly, they can get outside of their models. And once the markets start to end up moving more erratically than their models have predicted, they stop trading, and then the markets can really sell off because there's not as many buyers and sellers in it, okay, because you don't have the same level of liquidity. So it is a bit scary about how the markets have changed. Probably the single biggest thing that we've seen in here is the following. Let me explain this spreadsheet because I think that this will end up showing you an awful lot, okay? First of all, what we did, and let me come over to here, is that you're looking at S&P returns going back to 1950, okay? I want you to focus on these columns right here, okay? What you're looking at is that you're looking at the distribution of returns. So you can see here's all of the returns, and I have every day here going back to 1950. And what we did is that we basically took and we categorized these gains and losses into 100 buckets. You see these right here? And so if the market went down 20.47% or more, here's the count of how many times that happened, okay? Here are the counts of how many times, okay, the market ended up being within a different range. So let's take a look at something close to the money. Let's take a look at how many times, okay, the market ended up finishing somewhere. I'll just choose this one number. In this number, it says that since the S&P started in 1950, 3,539 days, the market has finished somewhere between 0.07% down, right? You see that number right here, that loss, and 0.25% gain. Okay, it shows you the counts. Now, once I have these counts, right, now this is just the way you do any type of distribution, right? Anybody who took statistics, okay, knows that, you have to end up doing your distributions. We just chose 100. I could have chosen 1,000, okay? We looked at different numbers. 100 seemed most reasonable. So we broke it up into 100 different categories, or 100 different bins is the term that we end up using. And then we just did our counts. And this shows you the percentage of time, okay, that we finished within a certain range. Okay, now what does that look like if I graph all of these? Now, if you graph them, the way you want to graph them is not the actual, you can graph the counts, but the problem is that if you're going to end up doing different distributions, it's a little bit more difficult. So instead of using counts, you use the percentage of time that the market moved within that bin. Does everybody get that? Because I mean, this is the most critical part of this. If you don't understand how distributions are made, and I realize it's very basic for some of you guys, and for those I apologize, but for those of you who didn't do a bunch of math in college and statistics classes, I realize that some of this is newer to you. And I don't see my chat. Where's my chat button? There it is. Okay, I don't see any questions, so I'm assuming that everybody's following along, right?
Yep, I don't see any either.
Okay, good. So what I want you to see is let's focus on this blue line. The blue line right here is all of history, right? You can see here all history is blue. It goes from 1950 to yesterday's price. Okay, and it shows you the percentage. These percentages down here is how much the S&P has moved. Okay, so if I look at, say, this bucket right here, it says, here's the distribution. Okay, 2.5. You can see it as I hold it over here. 2.5% of the time, the market has moved up somewhere between 2.19% and 2.52%. That's the percentage of time that the markets had that level of a gain in a single day. Okay. Now, what ends up happening is that in a normal market, this is your standard bell curve. If you take a look at the blue and the red lines, the blue line is all of history, by the way. The red line is history of one of the biggest bull markets we've had, right? I went from pretty much the lows that we had in April. We had the lows in March, but I started in April of 2009 through the end of last year. And you can see that the distribution of single day returns in the S&P 500, the red line, is pretty similar to the distribution of returns throughout all of history. Right? I mean, that's you can see they're very, very close. What's happened this year? This year is the green line. Okay. Here, when I do the distribution, you can see that all of the distribution, or a good chunk of it, it's kind of like somebody took a handle, okay, on the bottom of the bells, and they pushed it in and they squeezed it up. Okay, for those of you who are more technical, that's leptokurtic. If you take a look at the green, okay, it has a very a very thin top. Okay. Where a platykurtic means that we usually have fatter tails. Okay, thin on the top, thin tails is what we're in right now. And so if you take a look, I mean, that's exactly what we have, right? We have the top pushed up, the tails are lower, and it has shown a complete compression of volatility. Okay, we're still dumbfounded why. Right? Why has this happened? And say, well, is it just happening in the S&P? Any questions about that? No, I still don't see any. Good. Tom, if you see any questions, please, because I want to make sure that everybody gets this.
Yep.
Is it just the S&P? No, let's take a look at other indexes. Now, other indexes like the NASDAQ, they only go back to 1985. And while the graph might be a little bit different in terms of the buckets, that just means that the highs and the lows were different. It is kind of similar. Here, okay, the S&P has moved up a lot. I'm sorry, the NASDAQ has moved up a lot more than the S&P. And so it's been much more bullish. And you can see that the range is there. It's similar in the sense that here's all of history in blue. Here's the bull run from 2009 to 2016. And here's just this year's. The same leptokurtic, okay, structure, tall in the center, thin tails when you go out. Okay. Well, maybe the NASDAQ maybe the Dow was different. Now with the Dow's kind of interesting, right? Because in Dow, we went and we got data all the way back to 1928. Okay. So we have a lot of data on the Dow, and it looks almost identical to the S&P 500. Okay. Then we take a look at the Russell. The Russell's quite different. Right, the Russell's quite different. Yes, okay, there's been tighter distribution in this year versus previous years, but look at the distributions when it comes to this year versus the bull run that we've had. Some of our losses, you see, these are losses. For those that you can't see, this is the point here. This is the center line of 0. Okay, so this is 0.02 gain. And so this bucket right in here means that the market or that bin was between minus 0.2 and plus 0.02. Okay, you can see that some of the losses, okay, on the green line have just been smaller than some of the losses on the blue line during this bull run. But other than that, the graphs are pretty similar. Okay. Now, why is the Russell different than all of the other indexes? It's different than the Dow. It's different than the S&P. It's different than the NASDAQ. Okay, the NASDAQ 100. Okay, and the difference. Okay, the biggest difference, and we talked a lot. Amongst the all the option strategists and the different market. I'm not going to call them market makers, but they do make marks. But the guys that are the strategy guys behind the market makers, is that they don't write anything to end up looking at trying to arb or influence in any way, shape, or form the Russell. It's too difficult because, one, there are too many stocks. But even more importantly than that, because the thing is the computers are doing it so they don't care, the real reason is that since they're small caps, they tend to end up having much wider bid-ask spreads. And when you have wider bid-ask spreads, you don't have the same level of liquidity. And so they can't move in and out of these things at the rate or the speed that they need to. So they kind of just let them float freely. So there's less, if you will, institutional tinkering going on with the Russell. Okay, but this still doesn't make sense because remember, the algo guys, the high frequency guys, they want to end up seeing more volatility on a daily basis. They'd love to see volatility because they can end up establishing their positions, and that's how they end up making their money, right? They'll get in, okay, and then the market will run, okay, well, they're holding their position, then they'll end up getting out. And all along, they'll end up having these little, right, those are the major waves. Then they have these little waves where they kind of scalp. Here, there are no major waves for them. And that's the part where nobody can figure out. Okay, why is this happening? Personally, this is my personal thought. There's probably, either one or several very, very smart, okay, huge institutions that are very, very secretive and private. I'm thinking Jim Simon Renaissance, okay, out on Long Island. They're a fortress, right? Nobody knows anything about their algorithms, okay? I know some people who live close to there, and they have neighbors, okay, who work there, and they never speak about anything. They're like sworn to secrecy. I don't know why, okay, but if there's a way to end up, okay, taking money away from one institution from another, it's a bloodbath, and they will fight that to the death. Has somebody figured out how to take the volatility out? Now, bull market, not a lot of news going on. There's not a lot of cause for the markets to end up having volatility. But even if I do something like this, okay, let me show you. If I come back to the S&P, what happens if I don't take such a big range? Okay, what happens if I pick a I don't know, a nice calm range? If, by the way, if anybody, okay, there, what happens in 2015, 2016? Let's do that. First thing I need to end up doing is I need to copy this, and so that it doesn't change my dates, because these were formulas, because I wanted to have all of the data here. Oh, no. Screw it. Let me just write it. Okay. And so let's take a look at what happens in 2014, 2015, and we can look at this by year. 2014 to the end of the year, right? 12, 31, 2014. Okay, a little bit of a difference, right? And now, if you think about what happened in the S&P during the this time, just for everybody who doesn't end up remembering, and let me just do this. Let me get here's a graph, but let me get rid of all of these drawings. I thought there was hide. No, I don't want to do that. Sorry about that. Let me come over here. Okay, you know what? We're going to do SPY because I have unsaved drawings that I don't want to end up killing. Sorry, I'm just pulling it up. I'll get there 1 second. Okay, so here's a SPY. Okay, so what happened in 2013? Pretty calm, right? I mean, if you take a look at this, pretty calm, going straight up, a couple of little dips. The 2014, we had the one little dip, okay, that we had in October, but that was about it. So when you take a look at that distribution, there's somewhat, but nowhere close to where we are here. If I take a look at, let's go to 2015. I'm sorry, 2013. That was 2014, right? So let's take a look at 2013. Okay, 2013, even more similar to all of history. Okay, 2017 has been very different. It's been very, very different. In Europe, on the Eurex, for example, the margin systems, okay, changed for the cross margins, okay, on the Prisma system. Cross margins and interest, okay, for derivatives, okay, and maybe there's a solution for the OTC to have a cleared margin. Well, one of the things I didn't show you is, well, what's happened on this, you know what, let me just do this 1 second, let me go. Okay, so this is back now. I didn't show you this, but let's take a look at what happened with EEM. Now, I know that's not Europe, okay, I get that, okay, but it is international. And while we're a little bit different in terms of where we are here, the distribution in terms of where the center of the graph is, the center is going to be different because remember, the center, it makes up where the high and the low are. So don't be fooled by where on the chart this is. I don't care where it is on the chart. What I care is what the distribution looks like. And if you take a look, the distribution is always going to be near zero. It's exactly the same with EEM. Okay. And EM should be even more volatile, okay, than most others. Okay, and you know, not that it makes a difference, but I also end up having this. You can take a look at what's happened with the VIX. Okay, and this is the distribution of returns of the VIX. Now, the VIX is probably not the greatest thing because it's not going to move very much, but this is change in the VIX. It's not level of the VIX, so it's not really the greatest thing to end up looking at. I don't care how much it's changed on a daily basis. You think more about its level. Okay. But the bottom line on here is that right now, and this has happened, okay, before, where people who sell things like iron condors, nice white iron condors, they're thinking that they are, you know, they just found the greatest trade in the world. I know volatility is low, they're not getting a lot of money, but so what? The market doesn't move. It stays right in the middle. It stays right in the middle. So therefore, they're making money and they're printing it and they think that there's little risk. The problem with thinking that there's little risk on this is that if we go back to a 2015 type of scenario where the S&P lost I don't remember the exact number, like, 18 or 15% in less than a week. Um, Volatility can come in very, very quickly. Now, why? You always have to be scared when there's nothing on the horizon. There's an old saying that markets climb a wall of worry. Okay. Um, and that's a bit of a challenge because right now there's nothing to worry about. Okay. So the bottom line on here is twofold. Number one, the markets will continue to end up acting like this until there's a reason for realized volatility to pick up. If they have realized volatility does not pick up, implied volatility will not pick up either. There needs to be fear or something on the horizon. We need to end up seeing the intraday movement increase. And we look at all of these things. And right now, when I take a look at them, and I look at a lot of different things, like let me give you an example of just one of them. Let me come over here. I look at something I call my daily channels. Okay, this is the S&P futures on a 5-minute chart for the last 20 days. Okay, I end up drawing all the time. You can see here's the range that after we had the run up a few weeks ago on Monday and Tuesday, by Wednesday we started and we formed a range. Last week we formed another range. You can see this, the top gray box. Yesterday we sold off a little bit, but we kind of are within both of these ranges, and we tend to end up doing that. If there's fear on the downside, the fear is that there was a gap. Actually, it was a double gap. It was a gap from the week before, and then they overlapped it. And if there's a sell-off, I can tell you that bulls will step in. Like we had another gap here on the following, right? This was a sequential gap. We had a gap on Monday a few weeks ago, and then another gap on Tuesday. Well, the sell-off that we had 2 days ago filled that gap. So that gap's no longer. Okay, this is what happens as soon as certain technical environments come in and they're satisfied, a certain number of bulls will end up stepping in. If enough of them step in, they'll form a bottom and they'll bring the market back up. Everybody is trading, okay, so technically. The problem is that when everybody's in the same type of technical trade and they're all using the same, and right, we're all looking at the same graphs, when they break, they will break big time. And in August of 2015, may end up looking like a walk in the park when they do break. Are there any signs right now of breaking? Not a one. I can't find anything. And so what's a trader to do? I mean, how can you end up handling anything like this? The EAB guys, remember what they do for a living. They sell institutional services, right? They sell services to companies. They want to be able to end up doing this in a way that when the markets are volatile, business is absolutely great for them. Right now, with this type of distribution, because this is what all the money managers see, there's absolutely nothing. Absolutely nothing. I'm sorry, I missed questions here. Okay, so the red one's okay for 1 year. The red one, okay, so for those of you, again, color-wise, just to recap, because I know I see one question on it. The blue line is all of history, and this is the distribution for all of history. The red line is the history for range 1, and here's the dates for range 1. The green line is for range 2. What I currently have up is I have the bull run from after the financial crisis starting in April, okay, through the end of last year, and then the green is just this year, okay. Anyway, so I sat down and I thought, from an institutional point of view, for just people who want to end up investing, okay, how do you take advantage of this, right? There needs to be a way to, if nobody's making money with one trade, I mean, don't forget, this is kind of like a game of whack-a-mole, right? They can take money making capability one place, but something else has got to pop up, okay? So how do you make money, okay, when volatility is super low and put skew is extremely high? Somebody wanted to see the rut distribution again. And you can see how the rut distribution, okay, is very, very similar. Right, you'd kind of expect, yeah, there's been less volatility in 2017 than there have been in these others. So I'd expect there to be a little bit of difference, especially because there haven't been any losses. So you take a look at the distribution of losses that they had down here, where you're -1.5%, say -2%, versus minus, a half to 0.75%. Yeah, there've been smaller losses. So this is what I would expect. If you would have said, hey, draw these graphs out, of course, they're rigid lines, but you'd kind of expect this type of a structure for all markets, not just, okay, the rut and nothing else. Okay. How can you make money on this? And after a lot of thought, right, I went through this, and let me just close this thing up here so I can end up anybody, if you want to end up putting it in, I'd be more than happy to end up, what's probably, how do you take advantage of, how do you end up taking advantage of the current environment? My friend who passed away in July used to end up running all trade operations for Dreyfus. Okay, and he was a funny guy. People say, can you give me a tip? How can I make money in the market? He goes, shh, I'm going to tell you. This is the key. You ready? Buy low, sell high. Okay, so, and I'd end up laughing, and he'd always make fun of different things. But he's like, you need to know when things are cheap. You need to know when things are expensive. What's the cheapest thing you can see right now? Well, one of the things that Paul Demers and I have talked a lot about is how cheap the calls are slightly above the money. So when you take a look, and I'm just going to go out to let's say to November. If I take a look at the implied volatility, right, we're looking at an implied volatility of all different strikes. You can see when I take a look at the calls, or I take a look at the puts, or if I just looked at the out of the money, that when you go slightly above the money, this is where the implied volatility is the lowest. For those of you who like to see this on a curve, it's not the greatest rendition, and we don't use this, but you can actually find this in Thinkorswim underneath product depth. And what I'll do is, let's just take a look at, all, let's get rid of everything except for the one that we're looking at, which was the monthly Novembers. And instead of taking a look at I'm going to take a look at just the out of the money stuff. Okay. So what you find, you know what, I'm going to do just the, no, because there's this little bump in here where these are puts on this side and these are calls, and I don't want you to see that. And that's not. Let's just take a look at just the calls. What you find is that the lowest implied volatility is slightly above where we are, right? Where's the SPY right now? I'm around 250. Okay, so if you go up to maybe 260, that's where it's the cheapest. Now there's a different level, right? There's a different level. Let's say if we go out to December of 2017. Oh no, let's go out to 2018 so I can end up showing you the difference. Okay, and I'm also going to end up showing you December 2019. Okay. The skews look a little bit different, but if I was to highlight just this area in here, these are still the lower implied volatility. They're slightly further above the money, but the lowest implied volatility of any of this stuff, okay, ends up being, okay, near and slightly above the money. These are the cheapest options you can buy. Where are the most expensive options you can buy? Relatively speaking, because when skew is steep, that means that the puts far below the money are relatively more expensive. Okay, so going back to my friend Artie's theory of buying low and selling high. Okay, what do? We could end up buying options slightly above the money and selling options way down here. Now, this is not an options trade that you guys would normally do. Is anybody, can we do a quick survey of anybody who's ever bought a structured note, or even knows, or is familiar enough that even if you didn't buy one, you considered buying one? Can you just put a yes in the chat, or put your hand up, whichever's easier for you? Okay, so I'm getting a few. Okay, so for you guys that already own them, okay, I see how many percent? I'm getting about 10%, it looks like, maybe 12% of the people. So for you guys, just bear with me 2 seconds, because that means the other folks may not end up knowing what they end up having. What a structured note is many times they're built off of indexes. They tend to end up being built off of indexes like the Russell or maybe the emerging market index. Why? Because implied volatility is higher. This is the way a structured note might end up working. And I don't know, it's always going to vary. So the numbers are going to be different, but so it's just a theoretical. What it says is that no matter what happens over the next 2 years, you're going to end up making 4% a year on your money. Okay. However, if the market goes up by more than 20%, you're going to also get to keep your gains of the market if it goes up more than 20%. So that means if the market goes up 25%, not only do you make 4% a year, okay, kind of like interest, but when you're done, if the market's up 25% after 2 years, you get to keep the extra 5% of outperformance. Okay, sounds like a great deal. What's the catch? Well, the same thing kind of happens on the downside. If the market goes down more than 20% over 2 years, and we're not talking about tomorrow, we're talking after 2 years, okay, you're going to lose, okay, everything, okay, greater than 20%. So let's say if there's a horrific sell-off and the market sells off 30% over the next 2 years, well, you're going to end up losing, okay, that extra 10%, right? Because the market was down 30, you don't have to pay for anything for the first 20%. And in the interim, you get to keep 4%. Okay, because that's the kicker, right? Everybody wants their interest. So structured notes tend to end up being built to end up having the highest interest rate possible, because that's what everybody wants. Okay. Not a lot of structured notes have any interest rate at all these days because there just isn't enough there. So I got to thinking, well, if structured notes don't work the way they've built, okay, and all our stuff doesn't, how can I end up, building a product or building something that would end up being a reasonable way? Going back to, my late great friend, Artie, okay, what do? I thought, well, let me build a little bit of a different structured note. Now, when we did this, okay, some time ago, we were looking at buying a two-year call, okay, above the money. And so this is 2018. Okay, we were looking at buying something around 5% above the money. Okay, 5% above the money would be an extra 12.5 points from where we are. So we'd go to 250. So maybe we even buy it a little bit further than that. We'll end up buying a 270. Okay. And let me do this. It's going to end up being called a risk reversal, or they call it a combo. So the call that I'm going to buy is the 270. Now, what I looked for is what put could I sell so that this didn't cost me anything. I'm not looking to make interest on this, right? Different than a structured note. I'm not going to pay you anything on this pseudo replacement structured note. Okay, so 565, which meant that we need more strikes here. Okay, so 565, somewhere in here, maybe the 210 or the 205. Let's go with the 205. I know it's going to cost me a few pennies, but okay, I went too far. If they don't let me type it in, I have to actually go and pick a number, and it's just very slow. Okay, there we go. Okay, so it's a debt of 43 cents. Now, this is what the P&L curve looked like. Now, again, this is not an options trading. This is for a portfolio. So you're looking at about a 12%, okay, loss here, right? If I take a look at, and let me put this in over here. Oh no, I take that back. This is 15. Maybe we're looking about an 18. What is this? Boy, I'm sorry, I'm just having fat fingers here. Okay, so if you take a look at this, this is what this graph is saying. For virtually zero, 43 cents, okay, you get to keep all of the gains greater than 8%. And you don't have to pay any losses unless the market goes down more than 18%. Okay, when we built it, okay, we built it at a little under 5% and 13%. Now, once you put this trade on, and we did it for a little bit more than a year, okay, once you put this trade on, you have to ask yourself, from a historical point of view, what are your chances? Right? What are your chances, okay, of making money on this trade? Right? There's three possibilities that we care about. We care about losing money, breaking even is nothing, and we care about making money. Okay, so what are the chances that we make money? What are the chances that we lose money? Okay, we went back to the spreadsheet and we built the following. Okay, this was 5%, and this was minus 13%. And instead of this being a one day, we ended up doing it for a little bit more than a year. So we had a little bit more than a year's worth of trading days, and we had about 265 trading days. And this is where the numbers came out throughout history, right? Throughout history. We had a 10.7% chance of losing money and a 63.2% chance of making money. Okay. We're in the process of building these things, putting them into new structured notes and taking these to investment advisors. Because when you take a look at the probabilities, okay, of what you can end up doing, this takes advantage of one, historic low implied volatility, and two, a very, very expensive, way out of the money puts or put skew. Okay, so there's no easy way of being able to trade a market the way we have this, a very, very low implied volatility and very steep put skew. This was the trade that we ended up building. We're in the process of getting it, our marketing materials and taking this to market, selling it to other advisors. And basically all it is, right? You saw the trade, all it is a combo. You guys can put this in your own account. Okay, very, very easy. Oh, by the way, for those of you, okay, who, and there was about 10% of you who had a structured note, did any of you ever have it try to get out early before you 2 years? How liquid was it? How easy was it? Okay, just write in the chat. Okay, I'm expecting to see things like horrible, painful, non-liquid, okay, very, very difficult, not liquid at all. How easy do you think it would be to end up closing these SPY options or SPX options, right? The answer is super easy. Okay, you'll get a fair price. You get in and out anytime you want. Okay, so when we take this to market, we'll have the ability to not put a structured note where if I go out of business, you're in trouble. We'll put this in options, in the most liquid options in the world, directly in people's accounts, and you'll have super liquidity. You'll have real pricing every single day. And so it's a nice way to go to market in a very difficult, okay, very difficult way. And unless you're an options trader and you understand how to end up doing that, it becomes a little bit more difficult. Which options to use when? The answer is you're always going to pick the best ones on the day that you end up doing it. But our goal is to do this at close to zero, okay, and to end up getting the downside as wide as possible and have the upside be as close to the money as possible. So anyway, that's what I wanted him saying. And there now I see some questions. It's perplexing and said the least. Okay, complicated. The bottom line on it, it is perplexing. Here's if I break this thing down to the simplest that I can for you, there's a couple of factors here. Okay. Let me break it down to you to kind of summarize to make this as simple as I can. If I take a look at where the VIX is over history, we're near all-time lows. Okay. If I take a look at, where's that other chart? If I take a look at real volatility, because remember, the VIX is implied volatility. If I take a look at real volatility as measured by an ATR, and that's just how wide the range is, we're at all-time lows. Okay, if I take a look at any measurement of volatility, okay, and I go to buy it, right now we're at or near all-time lows. The problem, okay, of being able to just go out and buy stuff is that if you wanted to protect yourself in any way, shape, or form on the downside, okay, those puts, okay, to end up buying are extremely expensive, okay. Let me show you, I don't have that one here, so let me just pull it up from here. Oh, no, that's not the one. Skew long term. If you take a look at the red line, which is the 200-day moving average of, and basically what this one is, it's how expensive puts are below the money. So you have volatility at all-time lows. You have skew at all-time highs. Now I'm using moving averages, I'm making general statements, not this minute. So it makes every single type of trade that we've ever known and learned about expensive. Makes it difficult to trade. Or if you are making money, you're taking far more risk than you ever had before if the markets move. Okay. So how to end up taking advantage of that was the trade that I ended up showing you. If you want, if there's enough requests, Tom, I'd be more than happy to have another session and just build one or build several of them and teach you how to end up building them yourself. Okay, because it's not difficult at all. But what you're doing is that you're taking advantage of two things that are basically at, one's at an all-time low, the VIX and implied volatility and realized volatility, and one's at an all-time high, skew. So we're taking advantage, and those make our trading difficult and more risky. And this trade takes advantage of them. It's not a regular trade, though. It's much more of a replacement for a structured note. Okay. I'm trying to see if there's anything else. I think I answered that question.
Yeah, I think it's good, Jim.
Okay.
Probably a good place to stop. So nice presentation, good information. Thanks for sharing.
Okay, good. Anybody, if you write Tom or I an email and you end up just request, if you want to end up learning how to do these, I'd be more than happy to have a session with just the folks who want to end up doing this. We can end up doing not a roundtable, but another, a separate meeting on it. I'd be more than happy to do that. So thank you, everyone.
All right. Thanks, Jim.